Hi, today we're discussing a fascinating comparison between two popular type of mutual funds, thematic funds and sectoral funds. Now, if you ever felt overwhelmed by all the options in the mutual fund market, you're not alone. With over 170 schemes just in the sectoral and thematic category alone, it can be tough to know where to start. But don't worry, we're here to make sense of it all. Why is this topic important? Thematic and sectoral funds are among the fastest growing categories in the mutual fund space. In fact, they have become the largest category in terms of assets under management, amassing over 4.21 lakh crore rupees as of July this year. That's a staggering number. But what's driving this growth? And how do you decide if these funds are right for your portfolio? In this video, we'll explore how these two fund types differ, how they've performed over the last 5 years, and which one might align better with your financial goals. Whether you're a seasoned investor or just starting your financial journey, understanding these funds can help you make more informed decisions. Sectoral mutual funds focus on specific sectors of the economy such as technology, healthcare, banking, or emerging. These funds allocate their investments exclusively to companies operating within a chosen sector. For example, a technology sectoral fund might invest heavily in IT giants and emerging tech startups, while a banking fund focuses on financial institutions like banks, NBFCs, and payment processors. The idea to leverage the growth potential of a particular sector when it's expected to outperform the broader market. One of the main appeals of sectoral funds is their potential for high returns during periods of sectoral boom. However, this comes with a catch. Sectoral funds are highly concentrated and carry significant risk. If the sector faces headwinds, the fund's performance can take a severe hit. These funds are best suited for investors who have a high risk tolerance, possess a deep understanding of the sector that they are investing in, and are willing to monitor market trends closely. In short, sectoral funds can be powerful tools for seasoned investors looking to capitalize on short to medium-term opportunities. However, they require careful timing and an informed approach to minimize risk and maximize gains. Thematic mutual funds, on the other hand, take a broader approach. Instead of focusing on a single sector, they invest in a collection of industries tied together by a common theme. Examples include funds centered on manufacturing, ESG, which stands for environmental, social, and governance, or transportation and logistics. By spreading investments across multiple sectors within a theme, these funds offer more diversification compared to sectoral funds. The flexibility of thematic funds allows fund managers to tap into emerging trends and long-term growth stories. For instance, a thematic fund focused on manufacturing might include stocks from companies involved in production, supply chain logistics, and infrastructure development. This broader scope reduces some of the risk associated with concentrated sectoral funds. However, thematic funds still carry their own challenges. They require investors to have a strong conviction in the theme and a willingness to stay invested over the long term, even during periods of underperformance. These funds are ideal for investors who want to align their portfolios with specific trends or mega trends shaping the future while maintaining a diversified approach within that focus. When comparing performance, sectoral funds often shine during periods when their specific sector is booming. For example, PSU sectoral funds delivered up to 100% returns in the last year, and defense-focused funds provided returns of 130%. However, this performance is highly cyclical, and downturns in the sector can lead to steep losses. Thematic funds, while also sensitive to market cycles, tend to exhibit more stability due to their diversified nature within a theme. For instance, thematic funds tied to manufacturing have leveraged growth across production, infrastructure, and logistics to deliver consistent returns over the past 5 years. These broader themes often provide a buffer against downturns in any single industry, making them less volatile compared to sectoral funds. As for suitability, sectoral funds are ideal for investors with a strong understanding of specific industries and with a higher risk tolerance. They're great for those who are looking to capitalize on short to medium-term opportunities in a particular sector. Thematic funds, on the other hand, are better suited for investors seeking long-term growth by aligning their portfolios with broader economic or societal trends. These funds strike a balance between focus and diversification, making them accessible to a wider range of investors. Investing in thematic and sectoral mutual funds comes with its share of risk, and it's crucial for investors to understand these before diving in. Sectoral funds, with their focused approach, are highly susceptible to market cycles. While they may deliver exceptional returns during a sector boom, a downturn can lead to steep losses. For instance, infrastructure sectoral funds in the mid 2000s performed spectacularly until a multi-year lull set in, leading to stagnated returns for years. Thematic funds, while more diversified within their theme, also requires careful analysis. The success of these funds depends heavily on the sustained relevance of the chosen theme. Investors need to be mindful of market trends and economic changes that could render certain themes less attractive over time. For example, manufacturing or transportation focused funds may experience cycles of high and low demand influenced by macroeconomic factors. To mitigate risks, experts recommend that investors limit their exposure to thematic and sectoral funds to a maximum of 20 to 30% of their equity portfolio. These funds should be used as a supplement to core diversified investments such as flexi-cap or multi-cap funds. Additionally, maintaining a long-term perspective is crucial for riding out periods of volatility and maximizing returns. By taking a disciplined and informed approach, investors can leverage the potential of these funds while keeping risk in check. Portfolio allocation is an important aspect of long-term wealth building, especially when it comes to trends like the rise of electric vehicles. As a long-term SIP investor, your portfolio will naturally evolve to include new themes like electronic vehicles as they become more prevalent in the market. While dedicated EV funds or ETFs have recently emerged, such as the one launched by a new age mutual fund company, it's generally better to stay invested in a diversified equity fund. Over time, the fund will automatically incorporate these themes, giving you exposure without putting all your eggs in one basket. While considering thematic funds, such as those focusing on the tourism sector, it's crucial to balance potential growth with risk. The tourism sector in India is poised for growth with untapped potential and favorable government policies. By putting a large lump sum into a tourism-specific fund at a later stage in life may not be the wisest choice. A diversified multi-cap or flexi-cap fund may be a better option. These funds can include exposure to sectors like hotel, airlines, and ticketing companies, providing broader market stability while still benefiting from the tourism boom. Diversification ensures that you don't rely solely on one sector, making your investment safer over the long term.
Stack Wealth is a new age investment management company that helps you take your wealth to new heights. Our team consists of experts with 25 plus years of experience managing investments for more than 1 lakh investors. Our team of experts help you curate a personalized mutual fund portfolio based on your goals and risk tolerance. They help you decide your asset allocation. They also help you identify high performing sectors to help you generate additional returns. And finally, we help you manage and monitor your investments in real time. First, download the StackWealth app from the Play Store or App Store and complete your sign up by entering your mobile number and email ID. Now you can explore the app, get your personalized mutual fund portfolio, or browse our various investment opportunities. To start investing, you have to complete your KYC. Once your KYC is completed, you can start investing in your personalized mutual fund portfolio or explore our expert curated investment opportunities. If you're not sure where to begin, your dedicated wealth manager will help you. Now you can start an SIP or make a one-time investment. Remember, you can always pause your SIP anytime and edit the SIP amount if you want to increase or decrease it. Finally, you can sit back, relax, because our wealth team will rebalance your portfolio based on shifting market conditions, identify and recommend new investment opportunities, give you monthly portfolio reports so you know exactly how your portfolio is performing. If you found this video helpful, don't forget to hit that like button, subscribe to our channel, and tap the bell icon to stay notified. because we are making finance and investing as simple as possible for everyone. Thank you for watching and goodbye.